Great, thanks for the introduction. Welcome everyone. Had some really good speakers so far today and more to come. It's my pleasure to be able to share some of my nearly 15 years of hands-on trading experience with you all today. We're going to spend the next 45 minutes or so walking through how I look at and day trade the E-mini futures markets, but the principles and the examples and topics that we'll be covering are certainly transferable to other markets, other time frames. So it's very easily able to move around some of the concepts that I use to apply to your own trading if you may or may not be directly day trading the E-mini futures. Maybe you're swing trading or looking at some of the other markets. Lots of parallels and things that you'll be able to pull away from even if it's not directly related to your trading. So we're going to talk mainly about how to draw and use Fibonacci retracements. And I'll talk about why those are important and how you can better use them in your trading. So as Simon said, my name is Tim Racette, and I blog over at eminimind.com. So to give you a little bit of an outline, we're going to really cover three main areas. The first will be highlighting kind of the market structure and the importance of things that we find in the chart. So not necessarily having to layer on indicators and a whole host of things that can end up cluttering up the chart or complicating things or just making it harder to make a trade decision. So we'll talk about some of the basics of the market structure that I look for. Then we'll get into actually drawing the fib retracements, and we'll talk about the different types of retracements that you can draw, how to draw them, and then how to really simplify things so that you're not, again, overwhelmed or almost inhibited by some of these tools, and that you can make better, really quick, decisive trade decisions. And then the last piece, we'll look at the actual trade execution and managing of the trades. And again, focusing on simplicity so that we're able to process the information that we see that the market's giving us, and then be able to quickly turn around and make a decision and place trades or manage a trade or exit a trade without having so many moving parts that it becomes overwhelming, or the chance of making an error or a mistake is really decreased. So for those that aren't familiar with myself, again, my name is Tim Racette. I've been trading since about 2006, and I went quote unquote full time, where trading was my main gig here, since about 2009. And I actually got my start with swing trading. So I was holding particularly stocks overnight, and then I migrated. I did a little bit of options trading from there, and then I migrated over to the futures market. And now I do a fair bit of both, where I day trade the futures, primarily the E-mini S&P, and then I also swing trade stocks and options. I find that it's a very nice pairing, but day trading futures is certainly the more appealing area for most folks, just because the barrier to entry is a little bit smaller as far as trading capital goes, and the ability to show up to work, so to speak, place your trades, manage your trades, and exit your trades, and then be flat at the end of the morning or the session is certainly appealing. I know we've got folks from all over the world, and with the 24-hour Globex session and the ability to trade essentially at all hours of the day, there's certainly better times to trade than others, but regardless of where you're at in the world, you can probably find that window of whether it's the NYSE Open, the London Open. There's going to be opportunities where you're going to have lots of activity and opportunities to place trades, jump into trends, and see some good potential. So from that regard, the futures markets are a really good place to get going and get your legs underneath you. With the introduction of things like the micro futures, it allows traders to kind of take a step up from maybe a practicing account or a sim account, be trading real money, but really having that risk minimized, and then working your way up to the main ES or YM or NQ contract. So that's kind of how I got my trading going, was starting from the larger time frame, the daily chart, and then moving to the smaller time frame, and then executing on the futures. Futures are really nice because they're very, very technical, and even if the ranges are smaller, sometimes you'll see in the summer months where traders go on holiday, maybe there's not quite as much volatility in typical years in the summer as there is in the spring and the fall. But they're still they adhere to very strict sort of principles, some of which we're going to go over here today. I've had the pleasure of speaking at for the Money Show and the CME group and the Traders Expos, so it's always nice to get together in person. Virtual events are also a great way to gain a lot of knowledge really quickly, and then be able to sort of execute on what you learn, or try some things out right away after the presentation. So outside of trading though, I'm really big into mountain biking and exploring the outdoors. I spend a lot of time kind of getting outside, hiking, riding, mostly places around the US. And I'm currently in Colorado, but my home base is in Arizona. So I've graduated from Arizona State University, and for those that are on the YouTube and social media, you can check me out over at eMiniMind. Lots of free videos and good stuff over at YouTube especially. So let's kind of dive in and start with the basics of Fibonacci and the market structure, and then we'll work our way into drawing the fib retracements, and then we'll tie it all together with actual trade execution and how you can manage your trades. So a lot of us are familiar with the basics of Fibonacci. A lot of us have seen some of these Fibonacci drawings and things as they relate to nature, and especially in the art world, and various elements of the golden ratio. But essentially, the way the Fibonacci sequence is constructed, and as a way to kind of get us to why we would want to use Fibonacci retracements in our trading, we kind of have to back up a little bit and make sure we understand some of the basics. So we're essentially starting with 0 and 1 as our first two numbers in the data set. And all we're doing is really adding those first two numbers together to get the very next number. So if we start with 0 and then 1, and we add those together, 0 plus 1 is 1. And then we add 1 plus 1 together. Those are the next two numbers in the set, and you get 2. And then you add those two numbers together, 1 plus 2, and so on and so on. 5 plus 8 gives us 13. 8 plus 13 gives us 21. That's how the Fibonacci sequence is derived. And this was, by and large, pioneered by a guy named Leonardo out of Italy, all known as Fibonacci. And a lot of these numbers and the ratios that are derived from this Fibonacci sequence, like I said, can be found in lots of areas of our lives. And this, what we hear of as the golden ratio, or when we're looking at a face or a piece of artwork and looking at, kind of the different segments that make up, in this case, the rectangle here, that golden ratio is essentially 61.8. And you get that ratio by just dividing one number in the series by the one that follows. So if you just take any of the two numbers, 5 divided by 8, 13 over 21, 34 over 55, 89 over 144, then you get this 0.618. And that's what gives us the golden ratio. So when we're looking at things in nature, we're essentially looking at a ratio of 2/3, like in this rectangle's case, 2/3 of the rectangle gives us roughly that 61.8%. So now I want to shift gears a little bit and look at identifying the trend so that we can start to incorporate the Fibonacci retracements into a market context. So the importance of identifying the trend is so that we can find those low risk entry points or opportunities to get into the market that are higher probability. So if we go all the way back to the basics of uptrends and downtrends, we've got higher highs and higher lows forming a very simple uptrend, and then lower highs and lower lows forming the basis of a downtrend. And I like to kind of come back to some of these basics because we don't need a whole lot of lines and indicators and drawings all over our charts to really make sense of what's happening or interpreting the data. So if we can just get a sense of what the market trend is by going back and looking, okay, are we making higher highs and higher lows one after another? Are we making lower highs and lower lows one after another? Or the third option is we're not doing either of those things and we're just sort of going horizontally or moving sideways. We're not really going higher, we're not really going lower, we're just sort of moving sideways in a range. And so this is kind of the first place to begin, because if you're going to overlay a trading strategy onto the market, you kind of need to know, okay, am I looking for a trending environment to place entries, maybe on pullbacks or on bounces? Or am I looking for a range-bound market to place entries to fade the market at highs and buy the market at lows? And I'm not really concerned with a really big trend establishing. So if we can start by identifying the trend, then we can better position ourselves for the strategy and the trade execution that comes next. So the next piece of this is, okay, yeah, that's great, we can identify the current trend, but when does that trend actually start? When does the trend begin? And if we look at just, again, kind of a combination of a downtrend and an uptrend, and we start with, going back to the very, very basics, your football analogy of blocking and tackling, if we're looking at lower highs and lower lows, and you go through the chart and you kind of mark it up and you identify those lower highs and lower lows, well, it's that point where we start breaking a lower high if we're in a downtrend. So you can see how this high over here breaks the prior high. For a while, we were going lower high and lower lows, and all of a sudden we break what's called the swing high, or in this case, the lower high. It's taken out. And it's at that point when we pull back that a new trend, or the direction of the trend, has a strong chance of changing. So you go from a downtrend to an uptrend when you can take out one of those lower highs and actually put in a higher high. And then when you get that pullback and form the higher low, that's sort of kicking off. Now we're in a series of higher highs and higher lows. And you can ride that series of higher highs and higher lows, that uptrend, until we break a swing low. And so it's a really great exercise to just, print out a 5 or 15-minute chart for the day, or even print out a daily chart of whatever market you're looking at. And just go through and mark up, the highs and the lows, and you can either highlight or use a pen and kind of link together, okay, this section for the last 3 weeks has been in a downtrend, and then here's a little section that lasted 5 or 6 days that's in an uptrend, and you can really train your eyes to get a kind of quick adaptation to finding these areas. And again, it's important because we can then identify the trend early on so that we can either get in the trend early on and be in the move before the masses are jumping on board, or maybe we're already in, say, a short, and we can then get out of the short, exit the trend as it's starting to change, when that momentum is starting to shift. So that's why it's very important, because it helps us with our actual trade execution and managing a trade, whether it's getting in or getting out. That's the point where the momentum is changing, that it's going to be in your best interest to make a trade decision. So now as we look at taking the Fibonacci retracements and putting them on the chart, what kinds of things are important, what kinds of things are worth looking at and having on our chart. So if we just start with a very simple Fibonacci retracement tool, nothing really proprietary here, it's just all basic Fibonacci tools that would come with any trading platform. The key is that you always want to be drawing from the left to the right. So it doesn't really matter if it's an uptrend or a downtrend or a sideways trend, as long as you start your drawing on the left side of the chart, and as you drag your Fibonacci retracement tool to pick another anchor point, you need to be going to the right. So always going from left to right. So if we look at a very simple chart, you're starting on the left side. In this case, we're in a downtrend. Starting on the left side of the chart, so just picking the most recent high or the highest high from the session, and then pulling to the right to the next low point. If it was an uptrend, well, then we would just find the most recent low point or the lowest point in the session, and then drawing to the right would give you a high anchor to be looking for. So always going from left to right when you draw your retracements. When it comes to the actual trading or execution part, the area that I like to look at and place my trades is actually not a 50%, not a Fibonacci number at all, and it's actually just the 50% or the halfway back point. And this is something that was derived from the pit traders, who would look at the first hour's range in the S&P pit, and they just take, okay, the low for the morning and the high for the morning, and after that first hour had occurred, they take the low and the high, they divide it by 2, and they would look at that point, that 50% pullback, as an opportunity to get into the trend. So it's not really a Fibonacci number, but it's just a way to kind of assess or determine that, okay, we've moved in one direction. So in this example, we've moved down for 4 bars, and then on the 5th bar, we've pulled back to the halfway point. We've made a retracement halfway of the trend. And so this helps prevent us from, chasing a move to just be shorting at lows and maybe getting overly excited and jumping in a trend when, it's sort of already developed and you kind of missed out. By waiting for that pullback, or in the shorts case, for that bounce to the 50%, that allows to give us a little bit better opportunity for an entry. We've identified that the trend is down. It's established lower highs and lower lows. And if you can just be a little more patient and not jump in and, chase those lows down, you'll have much better entries, and you'll also be able to stay in the trend a lot longer. So if the 50% is kind of what we're looking at for the entry point, or the market to pull back to, how do we know when we're wrong, or when the trade is gone so far back that the trend is sort of deteriorated? Well, that's where that 61.8% comes in. And so that's what I use as sort of the trend failure point, where, okay, we've gone about 2/3 back of the trend that was just established. So if we moved up for the first hour, or for the morning session, we've moved up for a period of time, and then we pull back. Well, if we pull back, roughly 61.8% of the move, now the trend is in strong jeopardy of failing. So to simplify things, having the 61.8 as the failure point, or the stop point, is a great place to put your stops on your trades. Now, not every trade is going to, if it breaks the 61.8, turn around and go from a ripping downtrend to a roaring uptrend, but we're looking for, consistency over hundreds and hundreds of trades. So if you think of the Fibonacci tool almost as a lens or a filter for taking the market information, plugging it into this filter, the Fibonacci retracement tool in this case, and then using that lens as a way to say, okay, I'm going to place my trades at the 50. I'm going to put my stop at the 61.8. So I can kind of calculate that distance. Okay, there's 3 points between the 50 and the 61.8. So that's my risk. Or there's 2 points, or there's 6 points. We know we have a defined risk, and you can start to put some actual numbers, some reward to risk. Okay, if I'm risking 2 points, and I'm, what kind of reward do I need to see if I'm shooting for, let's say, a 60% win rate? Or if I say, okay, if I want to get away with a 40% win rate, and my average trade has a 3-point stop, what kind of winners do I need to see so that I'm, net positive? And so to be able to actually put numbers to a strategy and quantify it in a way that's repeatable is really the objective. There's a lot of ways to look at a chart, or to just almost haphazardly place entries at support and resistance. But the idea is we want to be able to replicate it, and to, on a larger statistical set, be able to as closely repeat the entry, the trade management, and the exit process. So in talking about the exit process, what I like to do is look for what's essentially the negative 23% line as my exit. You could also think of it as 123.6%, or said another way, 23% beyond lows if you're short, or 23% beyond highs if you're long. So essentially, we're looking for a trend to develop. We're looking for a little bit of a pullback so that we're not just chasing the trend. And when the market does pull back, or as in this example, when it bounces, to get into the trade in the direction of the trend, and then to ride that trend for longer than just a couple of ticks, for longer than just a scalp. We want to see that trend continue and take out lows, or if you're long, take out highs, but rather than just being exceptionally greedy or trying to hang on for that home run trade, realizing that there's going to be an ebb and flow or a stair stepping or a wave pattern, whatever you want to call it. The market doesn't just go from point A to point B in a straight line. There's a lot of ups and downs along the way. So if we can kind of consistently swing at our normal pace or our normal speed, to use sort of a baseball or a golfing analogy, and if we can just try to connect for those singles and doubles, occasionally you will catch a trade that really rips, and we'll talk about a couple of the ways that you can capitalize on sort of those bigger trades that end up turning into home runs without you really swinging for that home run. So we've got the 50% as our entry, the 61.8 as our stop point, and then the negative 23.6 as our target point. So that's a traditional retracement. And what ends up happening is, okay, we've got one retracement that completes. It goes from the 50 down to the negative 23. Well, okay, that's great, but what do we do? What do we do next? What do we do from there? And so once you have one traditional retracement going from, in this case, a short, so your anchor point is high and your second anchor point is low, you trade up to the 50 and then it trades down to the negative 23. What you can do is just use the high point around the entry. So where it's sold off, you can use that swing high as your anchor point and drag down to the next swing low. So the next trade in the trend would be just the next retracement short, using that anchor point at the 50 and then the anchor point down near the negative 23% target. And then when it bounces again, you can enter at the 50 and then you can hold to the negative 23% target, and you can kind of repeat that process using the anchor point near the entry at the 50 to the anchor point down by the negative 23, let it bounce to the 50, and repeat, repeat, repeat. So you can kind of see, okay, if you're trading multiple contracts, and if we back up on the chart, you don't have to take the entire position off at the negative 23. And this is great to employ regardless of the strategy or execution that you're using. You can, by trailing your stop in some form or fashion, and what I would suggest if you're using Fibonacci retracements is to trail your stop above the 61.8 if you're short, or below it if you're long. But this way, if the market doesn't make a retracement to the 50, let's say it just dives off a cliff, you get in at the 50% and it just nosedives and it doesn't make a retracement to the next 50, well, you're in the trade. It's still important to take some off at the negative 23. If let's say you've got 2 contracts or 4 contracts, taking 2 of the 4 off at the negative 23 and then hanging on to the other 2 and trailing that 61.8 as the market moves lower, you can stay in some of these trends for a little bit longer without having to re-enter, or if the market does really get going, without missing an opportunity to re-enter. So that's kind of the gist of the traditional retracements. But what happens if the market doesn't retrace to the 50? So up next, we'll talk about what's called an extension. So versus the traditional retracement, we're always drawing from left to right. So that all stays the same. But essentially what's happening, instead of going from a high to low or a traditional low to high, we end up drawing from, so this would be the traditional high to low drawing. We find a swing high, we draw down to a swing low, and we wait for the market to come up to the 50%. Well, in this case, it doesn't make it all the way up to the 50%. So that's a situation where you can utilize what's called an extension. And so what we're doing here, if you're long, you'd be drawing from a swing high to a swing high. Or if you're short, you'd be drawing from a swing low to a swing low. So that would essentially look like this, where you have a swing low drawn to a swing low. Again, always left to right, but instead of taking the swing high to low, we can draw from the swing low to low, and that kind of lowers the 50%. And this would be a situation where the market is very strong. The market is selling off hard, or the market is rallying pretty hard. So you can think of it like a bull flag or a bear flag, where the market is really trending strongly. And so if you get into the trade ahead of a sell-off like this, if we go back to this earlier part of the session, it's not moving incredibly strongly to the downside until we start to take out the low here around 30.72-ish, and then we start to kind of go almost straight down, or down in a much stronger fashion. So if you get into a trade and you're short and you're trailing your stop behind the 61.8, and all of a sudden it starts kind of nose diving off a cliff, you can draw up the extension that will help lower your stop, so you don't have so much distance between where price is and where your stop is. You don't want to leave, if you're let's say your initial stop on the trade was 3 points. You don't want to leave 10 points between where price is and where your stop is. You want to have a reasonable amount so that you give it some wiggle room. You won't want to trail your stop by a point or by a couple of ticks away from where price is. But if you give it, about the size of your initial stop, so if you started with a 3-point stop, maybe 3 or 4 points of wiggle room from where your max profit is, that can be a good way, or a good rule of thumb, to kind of keep your reward to risk in check and not give up too much on the trade, but still give it enough wiggle room to actually move. Because especially on the E-mini futures, if you aggressively tighten your stop too early, like it moves a point in your favor and you bring your stop to break even, you're very likely going to get stopped out before it even really has a chance to get going. Once the trade gets moving, once it's 3 points or 4 points away from your entry, it's pretty easy to manage and to trail your stop and just kind of follow along with the trade. But for any of you who've traded, especially the E-mini S&P, it can kind of chop around a little bit at your entry for 2, 3, 4, 5 minutes sometimes. And if you tighten your stop too quickly, then you just get kicked out before it even has a chance to move. So if you can be patient at the start, it will serve you well, and you'll be able to stay in those winning trades much longer. So sometimes it is too late and the market rips and starts screaming higher, and it just really doesn't get any kind of a pullback. And if you're not in the trade it's not worth chasing. And that's important to remember, that there's always another day, there will always be another trade if you have capital to trade. If you just start gunslinging and trying to chase a trade and doubling down and removing your stops and doing all these things that sort of are elicited by panic or fear, then you're going to blow up your account and you're not going to be there for the next day to take more trades. So sometimes it's okay to just not do anything. Sometimes you just miss a trade or there is no entry, and you just come back the next day. And that's why it's really important not to chase. So if you always focus on entering at a 50%, that ensures that you're not chasing the market higher or you're not chasing it lower, because in order to get in order to get a 50% entry, the market has to pull back in some form or fashion. So when it comes to kind of tying in the trade execution, we've touched on a little bit throughout already here, but the key is to wait for that break of the swing high or the swing low. So if we, again, look at the chart, taking out the swing high, as we've done here on this leg up, that sort of signals, okay, we were, let's say, in a downtrend coming in. Now we're onto the chart here, and we put in this low. We have lower low, lower high, lower low. Well, when we take out that swing high, that's our opportunity to draw up a setup in the other direction. And a lot of the time you'll see that pullback to the 50% kind of line up with the prior, we'll call this, the prior high. So, what was resistance over here can then act as support. So in some ways it might seem that, yeah, we're kind of arbitrarily drawing these retracements on the chart, but there's a lot of things psychologically that happen with the human component that make up the market, all of the traders that are actually looking and trading the market, as well as things that align with support and resistance, that happen to align with 50% retracements. So waiting for that swing high or swing low to break as step one, and then drawing up, having the 50%. A lot of the times when you first draw up a Fibonacci retracement tool, you have a whole bunch of lines. You can typically go into the properties or the edit settings and get rid of all the other drawings to kind of clean up your chart. So we just left with the 50%, 61.8, and the negative 23. This negative 61.8 I use as sort of an extension target. So if the market really gets screaming and it goes beyond the negative 23, then we have the negative 61.8 as sort of our next target. And then we talked about placing orders at the 50. Whenever I'm putting actual orders onto the chart, there's going to be times where the 50% or the 61.8, it kind of ends up being an odd number. So like the ES trades in quarters, quarter, half, 3/4, evens. Well, if you get a 63 cents or 36, something that's not quarter, half, 3/4, even, if you round and then add a tick, that ensures that you'll get your fill if it comes down and touches the price directly. And then when I'm placing my stops, giving it 2 ticks of wiggle room is totally fine. So just rounding down by a couple of ticks or rounding to the nearest tick and then subtracting 1 for a long. It's always better to give it an extra tick or 2 than try and stifle it. So placing the order at the 50 and then placing the stop just outside of the 61 again, giving it a couple ticks of wiggle room is good practice. And then same with if you're going to place a target at the -23. In this case, it's a 99.54, 30.99.54. Well, if you just round down to a 30.99, yes, you're giving up a couple of ticks, but it kind of helps ensure that if price just goes up to the -23 and reverses, that you get that fill. And I'd rather, again, give it a little bit of wiggle room than stifle it and get too tight with my orders. And then from there, it's just a matter of trailing the next retracement. So in this situation, you can kind of already see, okay, we changed trend, and then we pulled back to the 50, and then we kind of just took off and started screaming higher. Well, if we eyeball it, we can already tell that a 50% retracement is not going to touch over here. So when the market is moving beyond the -23 and goes up to this -61.8, that's a situation where, okay, instead of drawing the traditional low to high for the pullback, we want to look at drawing from a high to a high for that pullback. And a lot of times I'll use that extension or that high to high drawing as a way to mostly trail my stop versus placing a new trade. I like to get in at the traditional retracements at the 50% versus getting in on an extension when we draw from highs to highs, just because, by definition, the extended or the extension is meaning that the market is extended, and in some ways we have a little bit less room for the market to run. So the extensions are certainly not as common as just your traditional low to high or high to low retracement. And you could be looking at an intraday 5-minute chart. You could be all the way down on like a 1 or 2 minute chart, or what I like to use is the tick chart. So it's not quite a time-based mechanism. It's based off of the number of transactions. So that's called a tick chart. You could use a daily chart, but the idea is if we're making a full 50% retracement, the market has not really taken off yet, especially if we're getting in on the pullback. If you're swing trading, looking at stocks, holding stocks overnight, just the basic concept of buying strong stocks on a pullback, selling strong stocks on a bounce, it all kind of ties into this 50% retracement. If you're just looking at the E-mini S&P, or if you were down on the trading floor, taking the first hour's 50% retracement, or taking the opening 30 minutes of the 50% retracement, there's a lot of applications and ways that you can, or areas that you can place your trades. But this kind of process for 50% is your entry, 61.8 is your stop, -23 is your target, is a really good framework to apply to these different scenarios. So especially when it comes to the target, it's always nice to have a couple of contracts, or half your position that you can trail your stop. But it's just as important to be able to take some of the position off. It doesn't really do you much good to trade 10 contracts if you're taking 9 of them off for 2 ticks, and then you hold that 10th contract for 10 points. Because when you look at your whole position, all 10 contracts, as it relates to your stop, let's say you risked 2 points on the trade, you want to try and make roughly twice what you risked. As a an individual or a retail trader or someone who's not using high-powered computers to trade thousands of contracts and scalp the market. As an individual, it's hard to compete with that. So the way that we can generate an edge is to build up winners that are larger than our losers, but are also attainable. So if you're using a 2-point stop on the ES, getting a 4-point move is not that big of a move, especially in this environment where you've got volatility that is up in the mid 30s, even the mid 20s. A 15 or 20 point range in the ES is not that big. So to catch 4 or 5 points of that is not asking a lot. And so if you can use a 2-point stop and have roughly a 4 or 5 point target, that distance between the 50 and the negative 23, that can help build your edge. So you can start plugging in some of these trades, start with a sim account, make 50 or 60 trades, see what you can observe, work your way towards, getting 100 or 200 trades under your belt, and then work your way towards that, live account, and then do the same thing. Try to get, 50, 100, 200 trades. Now you have a nice data set to work with, and that can really help build confidence, eliminate hesitation or fear of placing a trade because you've seen the setups work, you've practiced the execution, and that sort of suppresses the psychological and emotional challenges that come with trading. So a couple of helpful tips. I like to start at the market open. I'm trading the NYSE session, so just starting at that 9:30 Eastern time works really well. I find a 5-minute chart if you're going to intraday trade is a really great time frame, and then pairing that with what I call the micro time frame, or that 512 tick chart, is very, very good for the E-minis. You always want to be drawing from left to right. We stress that a bunch. And just finding some significant low or high. If you're coming into the day and you're over in Singapore or Australia, and the market times don't quite line up nicely, or Hawaii, or your job just doesn't allow you to trade at a market open, starting the day by just finding the high for the session or the low for the session and drawing from there. Or if you want to go back in time and practice, that's a good way to do that. And then upon a failure of the 61.8, then look to trade in the other direction. So if you're drawing longs, you got 1, 2, 3, 4 longs in a row, and then one breaks the 61.8, that's when you can close, kind of switch gears from longs and start looking at shorts. So I always like to kind of close with this idea that there's really no shortcuts or substitute for that time in front of the screen. You can read about things or watch YouTube videos or follow along with other traders, but in order for you to really grasp, have the confidence, you need that belief in what you're trading. So if something resonates with you, if there's a strategy or a style of trading that resonates with you, I would encourage you to go deeper and really break it down and understand that trading strategy or that tool. So if Fibonacci's don't really make sense to you or don't resonate with you, find something that does, so that you can get behind it, you can have belief in it, and then in working smart, being very patient and building that discipline and that routine each day, that's what's going to get you to that consistency. If you just bounce around and you're going from one strategy to another strategy, or just kind of haphazardly entering and getting into the market, you're not going to build something that's repeatable, and that's the most important thing. So whether you're trading the E-mini S&P, the forex markets, any of the the futures markets, especially, you know, things like gold and crude, and some of the markets like soybeans or corn. Sometimes they can be a little funny. So I used to trade soybeans, and I don't so much anymore. But typically, you know, most of the commodities and the E-mini S&P and the futures markets are very they very adhere much to the fib retracements. You also have a lot of these computerized trading firms that use fib retracements. So there's a whole lot of opportunities where other, you know, bigger institutions are looking at the same levels. And so if you can focus your energy on, you know, working smart and employ some of that patience, and like I said, building that routine or that rhythm, that foundation to stay disciplined, that's what'll help build that consistency over time. So you can always, I've got lots of articles and things over at E-mini Mind you can read, and YouTube videos and things like that that kind of can help build that foundation regarding fib retracements and everything surrounding the E-mini futures. So lots of good stuff today. It can be a little bit overwhelming at times when you're taking in so much information at once. But like I said, if you find something that resonates with you, whether it's, you know, something a presenter says or just an idea that they have, you know, building upon that idea so that you can really master it is going to get you a lot further than trying to combine 50 different things, cluttering up your charts, having 5 monitors with 50 different markets on your screen. Is going to be a lot harder to master than just focusing on one market, one time frame, and one trading strategy. So I want to thank everyone for tuning in today. Thanks to Simon and Dan for letting me present. I hope everyone has a great rest of your day and enjoy the presentations.
Thank you, Tim. Yeah, fantastic. There's been a few questions that come in. I'll just let you finish up your talk, and then maybe you've got a couple of minutes now to take some questions.
Yeah, I'm just kind of flipping through the chat window here. I touched on a couple of them. One of the questions was about the Heikin-Ashi candles versus the traditional candlestick chart. I like to use the Heikin-Ashi candles. It's just kind of a little bit of a variation from the traditional candlestick that most of us are familiar with. But you know, a bar chart works just fine. You don't have to get super fancy. Simplicity is going to be your friend. Let's see, we touched on yeah, the different markets that you can use, especially things like Forex. It doesn't have to be the futures markets. Again, if you are looking at a market or a specific time frame and it, you know, it kind of makes sense, or it fits with your trading, with your, you know, your day job, or you're working your way towards full-time trading, maybe some markets aren't accessible. Find a time in a market that works for you. I would just try and stay away from very slow and quiet times, because if you're trying to force something on the market when it's not really doing anything, you're going to have a lot of frustration and end up with a lot more losing trades than if you kind of meet the market when it's the most active.
Right, I'll just chip in there that everything that Tim has said has been very much consistent with my own experience. I'm a big fan of Fibonacci, and I also traded futures like Tim. I traded the Eurex products, mostly the bond futures, the Bund and the Bob, and it was amazing how well those markets respected the Fibonacci levels. We were always super tuned into the 38% level. Like Tim said, the 50 is not a Fibonacci level, but it's a hugely important level. and it's kind of interesting that they added in there. And I was talking to Andy Pancioli about this because the 50 is something that Gann identified as being very important also, and as to why that's such an important inflection level. But really nicely explained, and the Fibonacci extensions too. So great presentation. Thanks, Tim.
Yeah, thanks so much, guys. And if anyone has any more specific questions, or if I did miss something, my email's there, tim@eminimind.com. Happy to answer any questions, trading or non-trading related.
Fantastic. Yeah, equally, or email myself, and I can pass something over directly to Tim. So, Tim, thank you so much for joining us. It's been great to have you on for the first time for our event, and really thank you for all your help and support, of course, as well in advance of the event. So it's greatly appreciated by everybody here. So hopefully we can do something again. I'm sure there's going to be a lot more questions following this, and it's really been super to have you. So thank you for your